Yes. Yes. June 17, Tuesday, on the brink of warfare. I have no idea what's happening in the market. I have no idea what's happening in the entire world. All I know is that, we might be going to war. I was actually thinking this is all like, just strong negotiation tactic. But in the last couple of days, I'm just like, yeah, we're going to war. Handed. I'm thinking that as soon as that first strike happens, that's basically the instant reaction is the bottom, right? So, I mean, we'll see what happens. Like, I'm not trying to go for the tree. I'm not trying to go for the fence over here. I mean, we had a wild couple of months. The market closed down about 1% on the NASDAQ, 85 basis points on the S&P 500. Robinhood had quite a comeback intraday, still closed down 2.5% after their little mobile technology live demo, which is really cool. Tesla's down about 4%. That's never going to catch a good day. But Reddit was up 6% today. CrowdStrike was up 2.5% today. And Cloudflare was up 1% today. Both of those made 52-week highs, but CrowdStrike, an all-time high, an all-time closing high on the brink of warfare. Crazy, man. That's cybersecurity for you. Where's VG at? Where's VG at? VG is just doing crazy things, man. Wow. Up 2% today. Holy crap, dude. That has been some stock lately. Next decade just chilling around $8.50. Grab had a little bit of recovery here, which is cool. But, overall, the market looks pretty risk off. High beta just got killed today after having like a crazy update yesterday. But, is what it is. ASTS is still above $40, which is pretty interesting to see. It's also interesting to see people get all bowled up in ASTS all of a sudden. But good to be early, I guess. Good to be early.
Yeah. I mean, today we could talk about a new one that is getting a lot of attention from retail. And it's actually one of the titles that I actually put in this. So we're probably going to talk about Oscar. But before we do that, we'll talk about some macros. Yeah. We'll talk about some macro real quick. So one of the things that we saw today that was interesting is that TLT actually caught a bid, and TLT had a, sharp-ish rise today compared to what it was. So if you looked over the last 3 to 4 months, you saw this kind of disconnect where when markets were going down, usually TLT would get a bid because people would be rotating into like safer things. We didn't see that. And what this is telling me is that the link that basically inflation is linked to some of the actions on the policy end by the Trump administration, we could be seeing a sort of a disconnect from that. So oil prices were up today, I think, and with oil prices higher, you would have thought TLT would have been going the other direction, but it didn't. So that kind of surprised me a little bit. So if you look at oil prices, they kind of jumped about 4 or 5%. I mean, if we're on the precipice of war in the Middle East, this is one of those things that you're going to have to deal with. So normally you would think TLT would actually go in the other direction, considering if oil prices and energy prices rise, technically we are going to be in a higher for longer scenario, right? In which case you don't want to be in long bonds. You just want to, stay away. But I think the market is finally sniffing out certain things. The
retail numbers.
Yeah, the retail numbers were poor, so that kind of helped. So basically it's showing that the economy is slowing, right? And if the economy is slowing, inflation is probably coming down with it. For me, I think the biggest draw is going to be in housing. I think housing, there's a lot of inventory coming to market, and at the same time, buyer demand is waning. And if we get past this summer and demand doesn't catch up because of high interest rates, which is the likelihood that we're going to have, what you're going to see is a lot of those properties are going to get flipped to next year. And so now you're going to have all the people looking to move next year, plus all the inventory from this year, and it's all going to add up. And we're going to go from a net deficit in the total number of homes needed to probably a surplus of things in the market, which pretty much bodes really well for inflation when you consider that about 30% of PCE actually comes from housing. So right now, housing is probably the area where we got to keep our focus in on when it comes to inflation. Energy prices, of course, are volatile, so it is what it is. I personally don't think that this is going to be as big of a deal as it's being made out to be. And oil prices, I think, are going to be a lot more muted than people think. And the only reason why I say that is because the Saudis have a lot of spare capacity. We here in the US, the shale producers, net rigs have been going down. But if oil stays above 70, they're going to ramp up production, in which case now you're going to have more more supply coming to the market. So unless there's like a ground war with Iran, I don't think there's a really big problem. I think what we're seeing right now is just some short-term saber rattling by both sides. And once that gets resolved, everything will be somewhat back to normal again. So I think this is a good time to find companies that are geared towards underperformance when oil prices are high. And those companies are probably getting beaten down right now. And then those could actually provide a nice tailwind going forward. So, just keep an eye on that, I guess.
It's actually pretty interesting because back in like the early 2000s, when we went into Iraq, you had pretty much a secular trend in oil for quite some time. And then it all basically just got dumped off after it peaked in the beginning of the great financial crisis, because commodities tend to not be as bullish when the economy is slowing down. Kind of a different story here. Bonds aren't exactly spiking. We did have a little bit of a pullback. I still think we're in range with bonds. I don't think it's really an inflection point. The inflection point might have been when TLT was in the 83s, when everyone thought the 10-year was going to go to like 5%. That was probably the inflection point. Now we're like still in a range. Like, I'm not saying it's going to sell off or anything, but we need to see like a wild breakout in TLT to finally see some moves here, especially with yields pulling back. You need a catalyst. Tomorrow could be it. You could probably get some dovish talk from Powell. Pretty clear they're not going to be cutting rates. Let me actually bring the CME chart here.
Yeah, and there's one other thing that eventually we'll talk about. It's regulations around stable coins. I think when you factor that in also, you could see a huge demand for T-bills, in which case now T-bills holders will chase the yield. They'll go for notes, and note people will buy bonds. And now you'll have like an entire cascade of demand for treasuries. But yeah.
So we have basically 100% chance they're not going to cut tomorrow. Even for July, it's like outlandish that they're not going to cut. September is when you start having a cut being priced in around 54%. And then December, there's an October meeting, but I'm just going to jump forward to December. You have a 40% chance they're going to do a cut. So that would be 2 cuts for the entire year. Go back to, I would even say more than a month ago, because this is pretty skewed here. But at the beginning of the year, it was like, we're going to get 6 cuts, right? Just too many, just way too many cuts. And you would think that after April and everything that we'd be back to like 4 or 5 cuts. Nope. It's not going to happen. Even though the data is pulling back, you're not going to get exactly that reaction you want yet, in my opinion. I mean, people who play the bond market, they have a lot of money and they're pretty smart, right? It's not like
I don't have that much money. Relax there, brother.
Yeah, all right. But no, but you know what I'm saying? Like the bond market is a very big market. When it moves in one direction, like that's a lot of money moving the market, right? So it's not like Archer Aviation or maybe Navitas or even CrowdStrike or anything. Like this is a multi-tens of trillions of dollars of money that are moving the markets. So with that being said, there needs to be a catalyst. Like it's not just going to happen it's not going to happen over time. Like it's going to happen out of nowhere. And that's usually how bonds work. It doesn't go on some massive gold secular trend where it runs like 50% over the course of a year. Like it just happens, right? So unless we see that happen, it might be a slow move up, maybe like a very slow move up. But I mean, if you're in bonds, I don't think the weekly options are anything you want to mess around with, because you just have to be reading the future at that point. So with that being said, let's get into some healthcare here. You did some DD on Oscar.
Yeah. So, everyone on Twitter is talking about Oscar. Like, it's like, I don't know what happened. Everyone. Dude, yeah, like you can't open up Twitter, like Finn Twit, whatever, Twitter, Finn, without 100 people talking about Oscars. So I dug deep and I was like, all right, let me figure this out real quick to see what's actually happening. And the numbers look very compelling, and it's moving the business itself is moving in the right direction. So we'll take just a look at the numbers first, and then I'll try to see if I can somewhat explain why people are bullish about this, and especially why the company had a sharp increase in the price yesterday. So let me just share my screen and we'll go over that right here. So Oscar, that's not wrong screen. Sorry, guys.
Oh, you don't want to share that one.
Yeah, it's a different window. There we go. Here we go. So this is Oscar Health. This is its financials. So you can see here, especially on a TTM basis, their premiums revenues are just absolutely exploding. I mean, they went from in 2020, $400 million to right now, 9.8 billion. Okay. One of the things about this is that they are essentially a low margin business, right? So they take in insurance premiums, they pay for people's medical care. It's not a very complicated business to understand. And the money that they make is the difference between what they pay out in care versus what they get in premiums. So the faster the premiums grow and the higher they grow, the more money they make, right? The thing is, there's a certain level of cost that comes with running an organization like this. And because of that, they've been operating with negative operating income for quite some time, as they were gradually scaling up the business. So if you were in Oscar Health over the last 5 or 6 years, the business wasn't exactly looking too hot, right? So you can see their operating income has been was very challenged before. But one of the things that you're starting to see now, and especially this year, is operating income is starting to go in the other direction, which means that all the investments that they made over the last 5 years in acquiring members and providing care, all of that infrastructure is starting to kind of show its benefits. So the way that any business works is that when you first open a store, it's probably going to be a loss leader, but then you open a second one and it's a little less losses. Third one is even less. And then if you go into 20 stores, you start to generate real operating income. Why? Because you can wholesale a lot of things, right? So instead of trying to buy, something for one store, you could go to Costco and buy something for 20 stores, and it's cheaper because you're wholesaling things. So as these guys get bigger, their operating income, of course, is going to keep growing. So the rate at which they're growing is pretty substantial. So if you just look at on a premium basis, it's absolutely exploding, right? So now that they're profitable, any chance of them supposedly going bankrupt is becoming a lot more diminished. So from an investing standpoint, typically when you have a business, if it's generating operating losses and it operates at a loss for a prolonged period of time, you have a pretty good chance that you're going to run into trouble and you're going to eventually lose all your money, and then it's going to go bankrupt, right? These guys don't have that problem. They have a very healthy balance sheet, and that right now they've got 2.2 billion in cash, and their total assets is about 5.8 billion. And if you look at their debt, their long-term debt is only about 300 million. So they've got plenty of cash to work with, which is what an insurance business is supposed to do. They take in all these premiums. Most of that money gets stored in the company at the company level, and they slowly pay out the benefits, right? And the cash hoard typically grows. The other thing is, as that cash hoard grows, you not only make money on the difference between the premiums that you collect and the medical expenses that you pay out, but that cash that you have on the balance sheet actually starts to generate income, right? So think of it this way, like you pay me ahead of time for something that hasn't happened yet. And I just take that cash and I use that as carry to basically invest in other things. So these guys, they're not going to go and invest in a venture capital fund where they could lose their money. They typically buy things like T-bills, corporate notes, and things like that. So if you look at Oscar's ratings, let me see, SEC filings. Let's just go over that. This is their 8K. 10Q right here. You can see my screen, right? The 10Q.
My bad. I was mute. Yep, I could see the screen.
Okay.
Yeah, make it full screen.
Yeah.
There you go.
So if you look at,
that's right.
Let me see notes. Let me just look at their assets. 1 second. Assets. Okay, so you can see here, these are the assets that they have, right? So anytime you want to look at a company, and whenever they basically, you go to any of these websites and be like, oh, we have this much on the balance sheet. Usually you want to see like, what do they actually own? So here, level 1, which is the most liquid, they have 212 million in cash. 2 billion of it is in treasuries, 500 million is in corporate debt, and the other ones are just asset-backed securities. They also, from what I saw, they do have some Fannie and Freddie debt as well. Let me see, like, where did I see that? So basically what they do is they buy notes that are issued by GSEs as well, because they typically come with higher yields. I have to find where I saw that. But essentially, this is how the company makes money, right? One hand, they collect premiums, they pay out a certain portion of it. That portion now goes to paying out for its clients and customers, everything else. The excess cash is then reinvested in other things which generate more money. So it's like your typical insurance business. So if you look at like something like Geico, the reason why Warren Buffett is so rich is not because he's the greatest investor of all times, which by the way he is, but it's because all the cash flow that Geico is generating, they're able to reinvest that, and that compounds over time. So Oscar's got to a point right now where they're generating excess cash flow, and that excess cash flow can be redeployed in other directions. So right now they're in that phase, which is good. So if you look 5 years ahead from now, if they're able to maintain that growth rate in the number of patients that they're taking on, that's going to keep boosting their profitability and that total return that you're going to get. So this is a $4 billion market cap company today, okay, with 2.2 billion in cash and interest earning assets. That's pretty freaking significant amount. And not to mention the policy benefits. If you look at their medical loss ratio, which is how much money that they're actually paying out versus how much they're collecting, it's pretty high, which is a good thing if you're looking at it from a business standpoint. Typically, medical loss ratios, they're regulated. Usually they're between 80 and 85, which is what the regulations are. These guys are somehow getting to 75. I was actually asking Matt and what's his name, Steven, about this yesterday to figure out like what the hell is going on. Like how are these guys so profitable? And I have a couple of theories on why they're so profitable. One of them is what they actually state. What they're saying is we are a digital first company. Like we are doing a lot of work with technology. So, the key focus for them is not, hey, let's build out a whole bunch of infrastructure ourselves and, have like this bloated system. Their thing is we're going to be very staff light. We're not going to have as many people doing busy work and doing paperwork. And what that essentially does is that because you're a technology first company, you have much better margins. So, if you look at how they do telehealth, they have like a lot of providers that they work with where literally you can just go to the app itself and just say, I want to talk to a doctor. Boom, you're connected to a primary care physician and, you can get all of your stuff done. You don't need to go to a site and do all of this other stuff. So there are things that they're doing that basically are somewhat disruptive. I'm not going to say they're completely disruptive, but they're somewhat disruptive to the traditional, like, hey, insurance mechanism. One of the things about them that makes them very unique is the patient population that they're actually targeting. So we're going to watch a CNBC video real quick with the CEO who actually explains it in greater detail on what they're trying to accomplish and what they're trying to do. And then once we watch that video, I'm going to actually show a very small clip. And if you miss it, you miss it. But if you don't miss it, it's very clearly stated in there. And that little nugget is why it was up 7% today. So let me just pull it up.
Cool. While you're pulling that up, guys, welcome. We're going over Oscar right now. We're going to be going over a couple of other stuff in a little bit. I want to touch up a little bit on Lemonade. Someone asked about doing that one. I am long Lemonade, so that'd be cool to talk about that one for a little bit after this. And then we're going to talk a little bit about GitLab and United Healthcare as well. So if you haven't, guys, please follow us on YouTube. We do stream these over to Twitter, but you can access all of our recordings at YouTube. All right, go for it, Chris.
All right, share my screen. Sharing the screen. There you go.
A few months ago, we spoke with our next guest about some of the problems in the health insurance industry and the issues with employer insurance. This time, we're going to try and focus a little more on potential solutions. Joining us right now is Mark Bertolini. He's the CEO of OSCR Health. He recently wrote a letter to the House Ways and Means Committee imploring them to consider some of the solutions that he's going to talk about with us today. Mark, by the way, is the former chairman and CEO of Aetna. And Mark, most of our viewers know you, but you are now involved with a small insurance company that looks at younger, healthier people that it's covering. But you've done Aetna, so you know the broad spectrum of.
So, Sam, can you share it so that our faces are still there? Because I'm going to try to do some live commentary while they're. So the first thing that, God, what's her name again? I forgot. I keep forgetting. Not Sarah Eisen. Damn it. I keep forgetting her name. Just like, I remember Sarah Eisen. I remember about Jerome. I keep forgetting her name. Whatever. The point is, she brings up something interesting. So the first thing she said was, what they're trying to do is go after younger and healthy patients. Typically, if you're a young, healthy person, you need insurance to get you through the day, but you're not going to fully utilize a lot of service, right? That is the first part of the business that that everyone should pay attention to. When you try to take care of people that are much older in their life, of course, they're going to have a lot more chronic illnesses and all the other things. So one is, which type of patient population are they targeting? And she brings that up. And that's actually a really good, Becky Quick. There you go. Thank you for mentioning that. So that's the first thing. So bull case number one, the patient population that they're targeting, young, healthy people.
What's been happening. We know pretty well that there are lots of problems.
Yes.
You've got some solutions. I want to dig into it because I've got questions about the solutions too.
Okay.
It's a little scary what you're proposing if you already have health insurance from your employer that you kind of like. Why don't you just discuss what you think is a solution to some of the problems you see out there?
One of the things is employer-sponsored insurance is they buy it for everybody in their group, which means a larger network, which gives you higher costs because a lot of providers in the system. Secondly, what it does is gives everybody an average benefit. So interestingly enough, last year, Americans borrowed $74 billion to pay for their health debts, their medical debts, even though they had coverage. And 1 in 5 people under 39 had problems with their medical coverage and had to borrow money.
Can I just ask, though, when you have a large pool, you do that so that the people who are the sickest don't wind up getting completely bankrupted. Like if you're talking about smaller pools, automatically I think, okay, you're going to take all the healthy people and the young people and leave the people who either are older, have cancer or some other disease, have children who need coverage because of special needs or along those things, and they get left out, and they're going to be the ones who are left holding the bill, literally.
Well, number one, the largest pool in America is the individual market, 24 million people.
Affordable Care
Act. And in that marketplace, everybody gets the same rate, regardless of their illness. So there's no underwriting of the individual based on their illness. And
so this is the second part to the whole equation that he just mentioned. Right now, as a group, when you have an employer, right, and you, let's say, have 100 people as employees, you're going to have people that are in their 50s, you're going to have people in their 20s, you're going to have people in their 30s, you're going to have people in their 40s. You all pay into a pool of money, and that pool of money goes towards paying for the medical benefits of all the people there. Now, of course, the 50-year-old is going to, of course, require way more in terms of expenses than someone who's in their 20s, right? Makes sense. Like, that's how you want it to set up, so that this way you get the sick people covered as well as the young people. one of the things that Oscar's trying to do, and he says it very clearly, is like, look, we want to, instead of having everyone work with employer-based healthcare, where basically the employer takes a bunch of their people and gets insurance for them, he's saying, no, everyone should just go into the ACA, which is the Affordable Care Act, right? Which is Obamacare. Essentially, you would go to the exchange every year and you would buy health insurance. And the way that that health insurance is provided is that it's not based on like if you're 50 or 40 or 20 and your insurance depends on your risk. It's just a fixed price that's out there, right? So that's what he's saying. That's one of the things that is the broken system, which is the 50-year-old is getting the same care as the 20-year-old, even though the 20-year-old doesn't need the care. And so instead of having care that's kind of tailored towards you and the younger guy, and your premiums are based on a fixed amount, you're basically helping subsidize the older folk in the other thing. So his thing is, his basic pitch is, we should get rid of private health insurance that's employer based. Instead, we should go towards everyone having ACA, which is Obamacare, right? So
they get subsidies if they're under certain levels of the income of the federal poverty level in order to help afford that. And so when you look at all of that together, a sick person doesn't get penalized. Healthy people get to buy what they want. 75% of all physicians in America are in the ACA. So I can find my doctor. I can buy a plan design that fits me, where often with a large employer, I'm overinsured because I've got the coverage that covers even the sickest people on a level premium. There's no employer large enough to get the same level of risk adjustment that the ACA has.
If I'm an employer.
Okay, so this is a second thing. When you go to Obamacare, it's not just $1 amount. You can get the bronze plan, you can get a silver plan, you can get the gold plan, and each one comes with like certain leveled benefits, right? So if you're a young guy who doesn't necessarily need a lot of coverage, you get the bronze. You're chilling, you're pretty healthy. You don't need all this extra stuff. You're not likely to get super sick. On the other hand, if you're an older person, you should probably get the gold plan because you need that additional coverage. And of course, you're going to pay more for it, but you'll be more covered. So the first thing is tailoring, right? So insurance should be tailored towards the individual, not to necessarily the group. So that's one thing that he's really putting out there. The reason why Oscar ran up today is because of exactly what he's talking about, which is if, let's say, all of these people that were on Medicaid end up getting into a situation where they have to do work requirements and everything else, a lot of them, if they get kicked off of Medicaid, they're going to end up somewhere. And where are they going to end up? In the ACA, which is the American Care Act, which is Affordable Care Act, which is Obamacare. And who's a major player in ACA? Oscar Health. That's how they've been able to grow their number really fast. So let's keep going. And he actually mentions this, by the way.
I like what you're telling me, because employers decades ago, for the most part, got rid of pensions. Those were costs that they couldn't figure out, unknowable costs that were growing at a much more rapid pace than inflation.
Right.
Healthcare is the new place for that, where companies look around and say it's outpacing inflation every year.
Definitely.
I don't want to deal with this. It costs too much. I would much rather pay a set fee and say, I know this is what my expenses are going to be every year. That sounds awesome for them. It sounds a lot scarier for the employees. And I go back to President.
Okay. This part right here, Becky makes a very good point. So what essentially you're looking at is employers have this choice where they can actually do, a group plan, or they could just pay your Obamacare, right? And basically you've got coverage now. You go to your employer and say, look, I've chosen a bronze plan, and your employer says, here you go, here's the money. And I don't have to worry about any additional costs, all this other stuff. I'm just basically taking care of your healthcare needs because you're my employee, but I'm letting you choose whatever you want to choose, and I'll just basically pay you for it, right? So it goes from, hey, we're going to pay for our employees. We're going to contribute a certain amount. The employee contributes a certain amount. But instead, now it's just, hey, here's the money that you can utilize for your healthcare, and you can do whatever you want. You can get the gold plan. You can get the silver plan. You can get the bronze plan, whatever you want. It's up to you. Right. So employers can do that for their people. Now, I'm going to keep going. Sorry if I keep interrupting, but if you watch this by itself, it's going to confuse the crap out of you. You have to really cut it down. That's why I'm cutting it like by literally each segment. So
President Obama, when he was talking about the Affordable Health Care Act, saying, if you like your plan, you can keep it. Well, not necessarily. That hasn't been the case.
Well, I mean, a lot of people have cut their plans, but their plans keep going down because employer costs keep rising.
Right.
In small business, middle market and small group, which is 1 to 1,000 employees, their costs for healthcare are double what a large employer has.
And that has been.
You're mute.
this is a really good point that he made, which is when you go to these health insurance companies and you have, let's say, 2,000 employees, you can negotiate better insurance rates than someone who only has 15 people, right? Like, let's say right now you own a very small company, you have maybe 20 employees, you're trying to get healthcare for your employees. How do you do it? Well, you go to like your Aetnas, your Uniteds, your Cignas, and you say, hey, I need health insurance for my people. And they say to you, well, how many people do you have? And you say, well, I have 15 to 20 people. They look at this and be like, okay, well, this is the price that you're going to pay. And it's usually a much higher amount because it's not wholesale. Versus an employer who has 2,000 employees, they go to these insurance companies and say, look, I will guarantee you 2,000 members, but you got to give me the best rates. So what he's saying is if you have a small business, if let's say where you're a freelancer, like let's say you work for Uber and you have a gig, you're a gig person, or you work for someone who's like a small company, very small company, like a small LLC, it makes more sense to basically, instead of paying for insurance where you have employer contributions, that you just give the money to your employees and say, here you go, here's the money that you can utilize for health insurance, and you go get it covered. So that's the target market that he's targeting right now. And this is one of the things that's going to help sort of reduce the cost for the employer side. Now, if you're an employer, especially if you have less than 20 people under you, maybe less than 100, you're looking at this and being like, wow, I could save a crap ton of money on administrative costs and all this other stuff by not having to deal with the Aetnas of the world and the United Healthcares of the world. I could literally just go to my employees and have, hey, this is the fixed amount that I'm going to give you for health insurance. You go to Obamacare and you get whatever you want. And now your liability is fixed. Like, you know, this is how much it's going to cost you. The other hand, when you go to these group defined plans, if someone gets sick, you're going to pay for the entire group. The entire, that pool of money is going to get kind of, used. Right. So we'll continue on with this.
I mean, what I was surprised when we spoke the other day, you said that at least in your area, in some places, we have managed to keep healthcare costs within the rate of inflation or below.
No, if you look at the overall ACA and its rate of increase over the last 5 years, it's been at or below CPI. And in the 1980s, that was what we called nirvana in healthcare reform. If we could ever get to a point where our healthcare costs rose at the same rate or less than CPI, we had a good program.
How can that be with the way Medicaid's been?
Well, Medicaid's not part of the ACA.
Okay, so that's where there's the issue.
So that's a very important point that he made. The Medicaid is not part of the ACA, which means if you got Medicaid, where do those people go? They go to the ACA. If you are low income and you can't qualify for Medicaid for whatever reason, you're going to go to the exchanges, right? And that's where OSCR operates. And that's where, once again, membership grows. And remember what I said, the more member grows, the more premiums they collect, the money that they pay out is what they pay out. The profitability stays within their ecosystem, and they basically make more money.
Here's a good question. Actually, it's like a two-part question. I mean, I guess it could be a good question. Sure. So is OSCR a competitor to Teladoc and HIMSS?
I don't know if Teladoc or HIMSS actually offer an insurance product.
I thought you were going to say you don't know if Teladoc is even a company anymore.
Well, no, I mean, Teladoc, from what I remember, they provide telehealth services. I'm not sure they have their own insurance. Like, these guys are their own insurance, right? HIMSS is not an insurance company. They provide insurance-like services, which is medications, right? That's what HIMSS does. Like, when you go to HIMSS, you're basically
an online pharmacy.
Yeah, they're online pharmacy with a a front end that can help prescribe things, right? So
in my opinion, more of a software.
Right there,
company.
is it not? Well, how do you fix that? Why, the ACA and Medicaid are related, obviously. Why do so many people need Medicaid, and why do so many states abuse what it's used for?
Well, the funding mechanism, the sharing between the states and federal government
That's what
isn't
does
very
it.
efficient.
That's what, not only that,
Not
but they get
efficient.
twice as much. So
Right.
they start saying that we're using it for this, that, and the other thing, and they're getting, reimbursed at twice the
And
rate,
the
and they're using it
networks-
for like these crazy programs that have nothing to do with healthcare.
And the networks are not as strong as the networks in the ACA. You don't have that level of participation. And so if we could add more individuals to the current marketplace,
ACA marketplace.
75 million people in small group and middle market employers, 20 million, 21 million gig workers in the economy. If you could put those people into that pool, it gets larger and it gets more stable.
Why do you have to go to the House Ways and Means Committee to get this? Why can't you just go employer by employer?
So Sam, this is a very, very interesting point to listen to. Okay. If you catch it, you catch it. If you don't, you don't. But
And say, come to us and do this.
Because there are certain, you lose tax subsidies as an employer when you do the defined contribution. So part of what we put in that bill was or that conversation was.
did you catch it?
Yo, dude. What
Did
a
you catch
slip. Okay, let's long Oscar right now. That was wild.
Did
I
you
don't know if
catch
that was
it?
a Freudian slip. Yeah, go ahead. Play it again. People missed it. Right. We're referring to the recent bill.
Why do you have to go
Mm-hmm.
to the House Ways and Means Committee to get this? Why can't you just go employer by employer and say, come to us and do this?
Because there are certain, you lose tax subsidies as an employer when you do the defined contribution. So part of what we put in that bill was or that conversation was let's.
Someone had a nip slip.
Yep. So one of the things that and this goes into geopolitics. See, I think a lot of times people think that when a lot of these laws come out, these bills come out, they're written by these lawmakers because that's in their title, right? You're a lawmaker. Most of the time, it's the lobbyists that do all the writing on the bills. And they're basically there to shill for whatever the lobbyists are basically pushing, right? So this guy, he basically wrote to his lobbyists because he probably has some lobbyists and some people. And he said, look, I think this would be a great idea for Americans. Here's the idea. And whoever the politicians are that are in charge in the House and Ways Committee that listened to this good gentleman, and I'm sure that they got a nice little donation to their re-election campaign, they put this into a provision. And there you go. So that was a very small nip slip, but it gives you an indication as to how things work.
That was a pretty big slip. I'm going to start looking at these options tomorrow, man. Look at the options, Shane. That is not like, you don't mess that up. Come on, man. You don't.
Yeah,
and that was like a very discreet way of saying it. Like it wasn't in like he screwed up
Yeah.
a word. Like
The bill we wrote, and it's funny. The bill we wrote.
All right. After
Let's
this,
make it
couple
possible.
minutes, then we got.
Secondly, there were.
Yeah. Sorry. What'd you say?
No, I said a couple minutes, then we got to move on. We got some other stuff to talk about.
Okay, we'll finish this up and then we can move on.
Restrictions back in the beginning because the Obama administration was concerned that if they allowed small businesses to put employees in there, they would put the sick employees in and leave the healthy employees out. And as a result, the network, the risk pool would get worse. Mm-hmm. And that hasn't happened.
Didn't the ACA expand Medicaid?
You're on mute.
So this was what a concern during the Obama administration, which was, let's say you're a 50-year-old and you need more care. Your employer could say to you, well, why don't you go to Obamacare? And the healthy people, we're going to keep you in our plan and we'll make sure we get a low rate for the group. But if you're sick, you go to Obamacare. So that was President Obama's main concern at the time. And basically one of the things that he's saying is that's not actually what happened. So
by extending eligibility to nearly every adult under the age of 65.
So in along with the ACA legislation,
Okay, so that's a fine
They
point. You're saying
expanded-
it's not part of the ACA.
it's not part of the ACA.
It's
Yeah,
not, it's not part of the
but
ACA
they
pool.
expanded it,
Right.
and that's why we're in this
And-
mess right now.
And Joe, the states that didn't
Right.
take it, like Texas,
Eventually took it.
no, they didn't take the
never
expanded
did?
Medicaid, and they've created their own state-based exchanges for the individual business. Georgia now has an exchange. Texas is building an exchange. Indiana. So red states are now saying, I get this. Get everybody into an individual market where they can buy the product they want at a price they can afford, have money left over for employees that have come out of defined contribution, so they're not borrowing money to pay their debts.
One of the statistics you told me really surprised me. The idea, I think if you said it's a 15 employees or less, if one woman goes out on maternity leave, it can raise the cost for the entire business's healthcare costs by double digits the following
10%.
year. How much?
10%.
10%.
On average. For one pregnancy
For a
in the group.
healthy-
Right,
a
a healthy event, a good event,
Yeah.
and it raises it by 10%. Because what happens is the experience of the group goes up and you have to spread it over 15 people.
Okay, so that is where we'll end that. So you understood that last thing. And this is where OSCR is trying to disrupt things, where basically their ultimate goal is get more people to the ACA. And because they manage all the people in ACA, because, when you go to the ACA, you can choose who you want. These guys are big providers in that. Then you'll be able to, get coverage and these guys will make money. And it looks like it's working. So if you look at the total number of membership that they have and the amount of revenue these guys are generating, it's substantial. So if they can maintain this growth rate, which in all likelihood, it seems to be working and it's going to keep working, this company is going to do very well. One of the things that I did notice, because I was like, okay, let me look up their NPS scores. Because look, if you're basically paying less for OSCR, your NPS scores are probably dog shit, right? Because you're essentially like providing, quote unquote, you're spending less money to provide care. Well, it turns out their net promoter scores are actually pretty good, which was surprising to me. And it's actually something that they highlight. So the people that do have this insurance are actually satisfied with it. They're not nearly as dissatisfied as some of the other big guys. The big guys, all like right now, if you look at their NPS scores, they're not that great. But these guys actually have pretty good NPS scores, which was a little shocking. Because typically when you have something that's quote unquote a value or discount based thing, usually satisfaction is on the low end. But it seems like whatever process that they're doing technology wise is something that that's working. And so, yeah. You're muted.
I was going to say their last 12 months are TTM revenue, and the majority of it is net premiums, which is really good to see for insurance companies. But yeah, they're still sitting above 50% for the last 3 quarters, which is really good. That includes their last quarter. So that is good. And as far as a valuation goes, I'm just going to look at forward price to sales.
You know, it's interesting. My wife, we were talking about this a little bit ago. Right now, we get our insurance through her employer because she works at a hospital system, and it's really good. Whenever I leave my job and she leaves her job, let's say we retire a little early, we're going to have to get our own insurance, right? And what are we going to do? We're probably going to go through the ACA and get insurance from there, utilizing this. So I thought about it, and I was like, you know what? One of the things that I've noticed over the last, few years is that the amount of people doing gig work has increased significantly. DoorDash, Uber, even like just, consulting and all this other stuff. You're basically a business onto yourself. And so a lot of those people are going to need care. And, this is an efficient way to do it. So as the percentage of the population goes from being just straight up W-2 employees to content creators and all this other stuff. One of these days, if we ever quit our jobs, you're going to need healthcare. I'm going to need healthcare. So what are we going to do? Probably going to go to Obamacare, so.
So I was like looking up some stuff here. Medical loss ratio is 75.4%. So apparently anything less than 80% in medical insurance is actually pretty good. So that is pretty good.
Well,
I'm no
well-
expert on this. I'm just looking at a bunch of different stuff.
Well, see, this is the part that I didn't get though, because technically speaking, your medical loss ratio isn't supposed to go under 80%.
Yeah.
Like it's actually a rule that's there that you can't collect more premiums than you pay out. I have to look at the actual regulations. And this is something that I'm doing more DD on, because if you look at this thing, it's just
Yeah, that's how they calculated their medical loss
right
ratio
here. So if you see this right here, so they have something called the 80-20 rule. Just share it right here for 80, like the medical
Yeah,
loss ratio, like often referred to the 80-20 rule, requires health insurance companies to spend a certain percentage of premium dollars on healthcare costs and quality improvement. Specifically, individual and small group plans must spend at least 80% of premiums on these items, while large group plans must spend 85%. If an insurance company spends less than a mandated percentage, they must issue rebates to their enrollees. This regulation is part of the Affordable Care. So maybe they have some rebates to send out. Maybe send out some checks.
We'll see. We'll see. All right. So, you know, by any request, if we get some requests to do some more DD and Oscar, we will certainly do that. I wanted to spend some time to talk about GitLab first, and then if you have some time, then I'll talk about Lemonade. So actually, hold on a second. Before we go over to that, I wanted to hold on. I wanted to go over the TA for Oscar real quick, just to see what we're seeing on the charts. Okay, so this is the daily chart for Oscar, and if we look over here, we got the 200-day moving average. We have the 50-day moving average over here. Sorry, this is the 50-day moving average, and then we have the 20-day moving average here. For like a long-term chart, like I want to see what's going on here just to understand what's happening. Hold on, this is an Oscar. This is Teladoc. Okay, so anyways, Oscar came back over here today above the 200-day moving average, which is actually pretty bullish when you think of for a stock, because a lot of fund managers can't buy stocks that are under the 200-day moving average, or they prefer not to. But now that we're back above the 200-day moving average as we were in May, I don't know, it looks pretty bullish. I mean, a couple of days ago would have been a much better time to buy. I still remember this when it was down here on Friday. You know, it was this one. I was like, okay, let me look into this weekend. And of course, this happened. And I didn't bother anymore after that. But above all the moving averages is pretty bullish, in my opinion. Big gap up ever since that bill, the news on that bill came out, which is definitely beneficial for Oscar. So it does have that fundamental tailwind. Yesterday or today had the third largest volume it had since pretty much 2023. So that's a lot of volume for today. It had the other volume. All three of those days were major volume, big volume days on green days, which is really good to see. And even these red days, like this big red candle here, wasn't even that much volume. It was just a little bit above the average volume it usually has here for the candle. So, you know, this is definitely looks like institution getting in. That's a lot of volume to have on 3 big green days. And it doesn't look like it actually left. It looks like it's been pretty stable outside of those 3 days, which means that that money's probably still sitting there. Now, this is just speculation just based on the chart. But to me, the chart looks pretty bullish. I'm going to look at the options chain tomorrow. I'm just curious. Anyways, I'll check that stuff out. So another stock that I wanted to talk about a little bit is GitLab. This is a cybersecurity, sorry, not cybersecurity. This is a DevOps company. They build a DevSecOps platform. So they built a platform that's based upon the continuous integration, continuous development of code for a lot of developers and engineers and product managers. And their platform is very similar, pretty big competitor to GitHub, which a lot of you guys probably know about. GitHub is owned by Microsoft now. They purchased GitHub. I forget. I think it was like early 2020, maybe late 2019 time when they purchased GitHub. Biggest competitor, obviously not nearly the amount of volume. We're talking about $1 billion ARR, a little bit shy of $1 billion ARR per se, but it got killed during its last earnings because the net retention rates were slowing down a little bit. And also the margins didn't contract as much as expand as much as Wall Street hoped it did. And to be honest, I think this theme of software development doesn't really get a lot of love from the market. That being said, the chart doesn't exactly look that great. Very different from the Oscar chart. This is below all the moving averages. This has been below the 200-day moving average since March, ever since it made its 52-week highs. And it's just been crumbling down since then. I would not necessarily say still in a downtrend, because we did have this sharp downtrend here from February to March, and then it broke out of its downtrend back above the 20-day moving average over here, stayed above the 20-day moving average, and then after its earnings just like fell off a cliff. So I wouldn't say this is exactly the most bullish chart that I'd be looking at right now, but there's a little bit of opportunity in terms of its valuation, because if I pull up the, let's see here, let me share the screen. I'm going to go back to fiscal.io, which is finchat.io. They rebranded themselves apparently today, but it's still the same platform behind all that. I'm going to go to GitLab and I'm going to pull up their metrics. So the company is it's still growing pretty fast, right? So last quarter, they were growing at about 26.8%, which is pretty quick, pretty big, but it is a much smaller company. Like last quarter, they only earned about $214 million on the top line, but still growing at about 26%. I think Wall Street still wanted to grow like up here around the 38%, especially when we're talking about revenues that are still in the $200 million range, which isn't a lot. But at the same time, it is a profitable company. They are not unprofitable by any means. They're producing positive free cash flow. They're producing GAAP profitability. Just touching GAAP profitability, it looks like here from, let's see. Here we go. Net income. Maybe that was, okay, they went under it. No, it's over here. I might have to flip these around. Let me actually pull up their earnings. Okay. Where is he at? All right. So first quarter results, $215 million in revenue year over year, 27%. Adjusted free cash flow is positive at $100 million. So they're at about 50% margin for adjusted free cash flow. But that is an adjusted metric. I don't want to sit over here and say like this is a GAAP metric, all important GAAP metric, but it is adjusted. So you can really have whatever reconciliation you could have on your earnings reports in order to come up with that metric. But whatever that they report on this one, it is about 50% margin, 49% margin to be specific, and non-GAAP operating margin is 12%. A lot of the software companies, they do report non-GAAP metrics, which is the non-standard accounting principles or whatever you see in the 10Q. They basically reconcile their numbers. Maybe they subtract SBC and so on to come up with a figure that's more accurate and more can easily be tracked based upon how well the company's doing from their perspective. But it looks like they are profitable on those terms. And one of the important things to see is that the company is still growing. They have a 2-year CAGR here at 30%. Anyways, not trying to sell the stock. I think what I'm trying to do is I'm trying to sell more of the valuation based upon its peers in the market. So if we go back to finchat.io, or fiscal.io is what they call it now. And then I'm going to go over here to the forward valuation, and I'm going to have enterprise value over forward sales. Okay. And we see over here that it's actually trading at a pretty cheap valuation in comparison to pretty much the last 2-3 years. If I pull up the median, it's basically half of what the median valuation is. It's at 6 times EV/TM, and enterprise value is basically the market cap subtracting the cash in its balance sheet. And GitLab really has no debt, so you're basically subtracting all that from its market cap, and it's trading considerably cheap, in my opinion, for a company that's growing at 26% and basically is one of the leaders in their market. And like I said, the biggest competitor is GitHub, and GitHub is the leader in their market. But something more, a little bit diversified away from like, cybersecurity, data software like Snowflake, Palantir, and so on. Maybe something on the other end with something that probably isn't talked about enough. But if you think about all the code that a lot of companies write all of their AI queries and everything on, and all the AI models, they're basically uploading all this code onto a source repository platform, which could be either GitHub or it's going to be GitLab. And I would think that with the amount of importance this has in a lot of industries and companies, this is probably something that I'm favorable of in terms of competition toward Microsoft per se. Obviously, you want to own GitHub. The only way you can own GitHub is through proxy of owning Microsoft, which is the reason why I don't own GitHub or I don't own Microsoft, because if I were to own GitHub, I would probably buy that stock instead of this one. But this is the only exposure you can get in it in the open market. There's other players in the field that do have a source code repository management solution, but they're not like a pure play like GitLab per se. Also on top of that, GitLab is already profiting off of its AI features, which is GitLab Duo. So think of like the chat GPT for GitLab is called GitLab Duo, and they're showing a bit of profitability on that metric. But even if I go back to this, the chart, I go back over here to the chart, and like I said, below all the moving averages, which isn't necessarily bullish, but if you go all the way back here on a larger time frame, to it's trading pretty much near its lows, with the exception of April, to all the way back in 2023 when they weren't even generating revenue. I think they're generating revenue half as much, and they weren't even close to this much profitability. So you have better fundamentals, and you have in my opinion, you have a chart that's pricing a stock probably not where it should be. Now, in my opinion, though, you need some time on something like this. So if you were to own something like this, you wouldn't want to own like options that expire next month. You want to own something that expires much further. But with that being said, I don't want to get into too many details as far as my positioning goes on it. One thing I also wanted to go through are the price targets that analysts have for this company. And considering Wall Street does like this company, because most of the price targets that it does have are actually well above where it is right now. So if I go back onto fiscal.io, I can go to estimates, price targets, and you could see here that the lowest price target on Wall Street right now is at 45, which is trading above where it is right now at $41 or $42. And the highest price target is $90. So it's probably not going to go to $90 in the next week or two. But I think that the fact that this is mispriced does give it that margin of safety, where if you even take the lowest value, the lowest price target, which is $45, you have about 8% margin of safety, which is pretty considerable. If you take the consensus, which is basically the average of all these, is about $67. So you basically have like a 60% up from here just to reach that medium price target. And it's actually gotten, I would say, fairly close to that price target until of course, they were revised up after their quarter, a couple quarters ago back in December. And even going back as much as February, they were trading in the $70 range, and that's when analysts were raising their price targets. So generally speaking, analysts tend to be somewhat bullish of stock. Just looking at this chart down here, this is the price of GitLab, and then this is the consensus price target. And you could see here that analysts always keep their price targets above where GitLab is, which just generally shows that Wall Street is bullish this company. Otherwise, this price target line would always be below the price target of the stock. I can't think of one off the top of my head, but that would generally be a bearish sign. So you have Wall Street bullish on the stock. You have the fundamentals behind it as well. You have the leadership in its industry, and then you have the valuation. I think a lot of that recipe goes for a small candid position in going along this company. So do your own research on that one, guys. And next one I want to kind of go over a little bit is Lemonade. This is one that I've been long since like the high $20 range. It's gotten quite a bid lately, but it's gotten wrecked in the last couple of days, mostly because it's been basically going up for the last couple of weeks. So not surprising to see that type of move here. If I go to the chart for Lemonade, this one looks a lot more bullish than GitLab, in my opinion. I mean, it doesn't take genius to see that one. But if we look at the chart over here again, above all the 200-day, above all the moving averages here, 50-day, 20-day, and 200-day. The 20-day moving average is here around $30. So I was accumulating these shares when it was under $30, and then now sitting pretty nice on it. Where do I expect it to go from here? I mean, it's down like 10% today. I don't know exactly why I was down 10% today. I was focusing on Marvell Technologies AI Investor Day. You know, I mean, high beta, small cap stock, not exactly, I don't think it's gap profitable yet. I'd have to check. Actually, maybe it is. I got to check my notes again on that one. But, you know, a day like today where the market's down about 1%, like, of course, this is going to get hit. So you got to keep that in mind. The volume today was pretty strong, in my opinion, versus the other days. So take that as an indicator. Might have been some institution selling over there. But at the same time, the market was quite bearish, right? So the last two larger volume days were back over here on Wednesday. You had big, large volume days and big green candles. So like that's usually good to see in the large volume days. This one, it was larger than average volume, so maybe not exactly. And yep, that's true. That's right. The short float is pretty high, so maybe the shorts reloaded their shorts today and so on. Lemonade wasn't the only one that got hit today. Hims didn't do so well. Actually, Hims did okay today, but Robinhood got hit pretty hard today as well. Tesla. So, you know, high beta is going to get hit today on a day like today. One thing that I wanted to go over with Lemonade, something that's also important for insurance companies is, let me go back to fiscal.ai. It's fiscal.ai, not IO. I think I've been saying fiscal.io. Anyways, let me do some Lemonade business here. Yep. Same Lemonade's making me a little thirsty. I'm a little thirsty. I might go for some lemonade after this one. All right, let this thing load. Come on, let's go. Let's go. All right. Not going to take a whole lot of look at the analyst price targets for this one. Actually, let's just take a look at it just in case. Yeah, there's not that many analysts that are really looking at this one, so it doesn't really tell anything. If I go back here, I'll go into the segments and KPI, and I want to look at in-force premium. So in-force premiums is kind of like your forward-looking indicator on where an insurance company stands in terms of how much money they would realize in terms of contracts that they sign with clients, annualizing that to the next 12 months. So if they have their same clients with their existing premiums staying signed up today, and then project that 12 months from now, this is how much they would collect in the next 12 months. And what you want to see here is that these in-force premiums are going up and to the right, and they certainly are in this chart. And also on top of that, the in-force premiums have been reaccelerating lately. And that's very good to see when you think of an insurance company, because that just shows that not only are they projecting retaining their customers, but they clearly have shown that for the last 6 quarters here, but they're also reaccelerating the in-force premium. So then that means that their premiums are going up as well as the amount of clients that they have. And if you look over here on the gross loss ratio, okay, so the gross loss ratio, you're basically taking the amounts of costs that there are for the company, and also in terms of how much claims they have to actually pay out, subtracting that from the amount of money they get in their claims. So like you want to see this number go down. They did have a little bit of a bump up last quarter, but of course we had the California fires and all that stuff, so that did impact those numbers. But more importantly, it's still staying below 80%. And aside from Oscar Health, we're talking about 80%. This one, you want to stay like below 80%. But even some analysts on Wall Street, they say that, you know, this is very impressive that Lemonade is able to sustain these much lower gross loss ratios versus other insurance companies, especially as they're scaling up, right? So this company, their total revenues are at about 151 million. And if I look at the revenue growth here, they're growing at about 27%. If I look at their net income, they're not GAAP profitable, but they certainly are heading there. If I go to their cash flow statement, let me close these out so we can get a bigger view here. If I go to the cash flow statement, it looks like here that they are not free cash flow positive, but I think that just might have been something from this. I forget it. I got to take a look at my notes again. But there was a stipulation that they had that did cause this remark here. If I actually look at their cash from financing, that looks like it's about normal. Yeah, it was cash from investing, And then what was it from the cash flow? Investing in marketable securities. So this is probably what did it here. So this was actually in the positives last quarter. And then there was a big negative tick over here in the quarter from September, and then they've been positive before that. So if we were to actually adjust this minus 38, and in addition, they had a expense here that was pretty big actually. Let me take away the change.
Let me just pause you for 1 second.
Yeah.
For some reason, when I relink this to Twitter, I can't comment, and I want to just comment on something what one of the guys says. So GTAN actually wrote something I forgot to mention. Actually, it's very important. The one before that, which is Oscar. I think there's something like a switch from pensions to 401k. Yes, defined benefits to contributions. So essentially, it's the same thing. Instead of having to basically give them a benefit, it's like, here's the money and you do whatever you want. So it's like a retirement fund with a 401k, which is whatever you put in there will match, instead of a pension that takes care of you, right? So whenever went back in the day, you would contribute to a pension, and when you're retired, that pension would pay you. That all went away, and now employers are saying, here's money for a 401k, we'll set that up, and whatever you contribute, we'll match it, all that good stuff. So that's exactly the business model that these guys want in the future with employers, especially small and medium-sized businesses, which is, instead of having pensions, have something like this. So just sorry to interrupt. Go ahead.
No, you're good. You're good. You're good. So what I was trying to say was that I guess because of all the fires in California, that threw off a lot of their numbers. But when it comes to insurance companies, what you really want to focus on is the forward-looking indicators here. And for this insurance company, you want to focus on the in-force premium. And yeah, you could also focus on the customer growth as well, because customer growth is also increasing pretty rapidly here. So you have about 2.5 billion customers here. And do I have the change over here? Yeah, I do have the change in number of customers. So yeah, that's also accelerating as well. So it's good to see that. And that would actually explain why in-force premium is also going up as well, because you're signing up more customers means that you're signing more contracts, and those contracts projected 12 months forward. It's obviously going to increase the amount of in-force premium. So, this is like another one of those things where it's basically, my opinion, would still be a speculative stock because they're not profitable per se. I don't doubt that they're probably going to reach profitability in the next year or two. But at the same time, it's not something that I'll go like full port in, or even like of a huge size in. I think I'm not that up much anymore. I was before, when it was about $42 or something, but now, not so much tracking the P&L on it, more about the long term in that one. So going to continue holding on to that one with a basket of other small cap stocks. But, at the same time, I mean, take a day like today. If we even look at, I was talking about this earlier at the beginning of the stream, but if we look at, just the performance, a lot of stuff today, like you had clear leadership in certain companies, right? Like this is just right across the board, but AMD was green. I don't know how much leadership this is, but anyways, that was green. Dell is green. So like the AI narrative is still there, because like clearly they're pretty strong today. Of course, high beta is down quite a good amount. Navitas is down like 5%. That's one of NVIDIA's recent partnerships for powering the data centers. VG is green, Celsius is green, leadership sticks around, man. Duolingo is green, Grab is green, and so on. LifeMed is green. LifeMed is a pretty interesting one. I wouldn't mind talking about that one on a different one. IFP should make a big jump in the coming years due to push on. Yeah, actually, that's true. They're trying to push a lot more car insurance, and I wouldn't be surprised if we start to get some car insurance that makes them more attractive than other car insurance companies when it comes to full self-driving and all the capability. So that'll be pretty interesting to see how that turns around. But yeah, I mean, a cool story to keep track on. Other than that, that's pretty much it for me. I think we hit a lot of points here, give a lot of DD on Oscar. I wanted to touch on ad tech. You got a minute?
Yeah, go for it.
All right. So Reddit was up like 13% today. I woke up and I saw Reddit up that much. I had no idea what was happening. All right. Like I would not expect to have seen this stock up so much. It's under my ad tech here. I mean, it's just been basing out for a while, and I finished my accumulation of the shares in this company and kind of just holding on to it for its ride. I did a little bit of DD on this one on the stream before. So if you want to go into the history of Hidden Edge Pod, guys, on our YouTube page, you can check out some videos that I did talk about Reddit a little bit. But I mean, this was, of course, a stock that a lot of people were chasing back here in late January, early February, went all the way to 225, which is ridiculous. I started buying in the low 100s and finished building out position, I think, in late March, early April. So just sitting on whatever there is right now, but had a big update today. But this is not the candle you want to see, especially a day like today. Reddit does this a lot. So when you own this stock, you will learn that certain stocks do certain weird things and continue having those weird patterns. So I would not be surprised if Reddit ends up in the low hundreds again. If it is what it is. That's fine with me. I don't really care. But at the same time today, the news that came out, excuse me, let me get some fake Starbucks drink over here.
While you do that, if you guys could please like and subscribe, that would be very helpful. We're trying to at least trying to get to that 5,000 mark one of these days. So if you can, please go to YouTube and hit the like and subscribe. You don't gotta pay anything. You gotta subscribe to anything.
We're not gonna talk about promo codes or anything, all right? Like,
yes, there's no promo codes, nothing. It's just me and Sam. Two guys is talking, trying to explain things and hopefully provide value, like we did with Venture Global before anyone else did.
Was a good one, dude. Honestly, Venture Global, even to this day, no one still talks about it, which is great. I like
because it's not a retail heavy company.
Yeah,
people don't understand the energy side.
Honestly, it's catching a lot of tailwind from the. I think it was up a lot. I think it's been up lately because of the EU deals that are coming around. So anyways, going back to Reddit, I'm not going to be surprised if it ends up below the 200-day moving average again. Of course, above the 200-day moving average is great. This volume is ridiculous that it has today. The last time it pumped up that high, even after earnings, it didn't have that. Actually, no. What was this? This was not the earnings day. But where are my earnings charts? Hold on.
If you want to create a few
there we go.
Ghost accounts and subscribe, that's cool too. I don't really care.
Okay. Yeah. So yeah, this was earnings. It actually sold off into the earnings and then it popped up during that day. Yeah, I don't know if you guys remember this when they had earnings that day. It was like in the 140s, and then the CEO said something how it's like they're going to be impacted by Google search being an issue, and then the stock basically gave away all of its earnings gains. And then here we are back again here today, pretty much where it was in the earnings. So, I mean, the institution is there, it appears. I haven't looked at the short float, not really too concerned about that one. This is a profitable company. They have wide margins and everything. Like this is not a speculative play in my opinion. I think I size this one up pretty good. I'm just going to ride this one. And, oh, hey, look at that, Chris. Someone made some money from you. Right. Anyways, yeah, I mean, as long as it stays above the 200-day moving average, I think this is still a good trader stock right here. Not here, but as long as it stays above the 200-day moving average, maybe. I'm not trading it per se, but this chart looks pretty good to me. You got to see some follow through in the next couple of days, depending on where the market goes. Like the market's down tomorrow. This is probably back below the 200-day moving average, back below 125. And if it is, that's cool. That's fine with it. I'll live with that. That's no problem. But at the same time, there was that news today with the AI-powered ad campaigns and tools that it's releasing to its advertisers. And, whatever the hell that means, haven't looked into it too much. The market clearly liked it. But I think this is like one of those situations where you have a company that's it's Reddit. Okay. It's like the company where you can basically collect all the data. Like if you do it throughout its entire platform, you can collect the general sentiment of a lot of different populations out there and a lot of different groups of people out there just based upon keywords or whatever in a thread, right? And how many upvotes it gets and so on. Reddit has that data. People don't just stop using Reddit, in my opinion. People still use Reddit to this day. Even if you do certain Google searches on or certain chat GPT queries, or even certain Gemini queries, whatever it is, like it will bring up Reddit results. And I feel like they're figuring out how to do that. So initially it might have had that brick wall for them where they weren't able to figure it out, but having confidence in the management to be able to figure it out because they have been figuring it out for 20 years, I'm confident that they will figure it out again and how to monetize the solutions. And I think they are actually doing that. And I think that the market is figuring that out. And I think it's getting re-rated because of that, to see that they're on top of their game when it comes to AI by figuring out how to utilize AI for their search, so not just their search solutions, but also their ad revenue. Because when you think about Google search dying per se, and that's quote unquote dying because it's not necessarily dying. But when you think about that, it's all because of running AI, right? You saw all those Google commercials that's been on lately where they're not talking about searching in Google. They're talking about asking Gemini, right? Just ask Google is the quote that they're having on there now. So how is this going to benefit Reddit? Well, if those queries point to Reddit for certain questions that people are asking as resources, then guess what? Those queries are going to go into Reddit and sift through all of the threads and so on to pull the information. And if Reddit figures a way how to monetize that, even though it's AI searching through their boards, well, then guess what? The company is still going to remain a strong company and a strong leader. So in my opinion, I think I actually think that this is probably still a good opportunity at these levels for maybe 4 or 5 years with this company. I would even say probably 2 or 3 years, as long as the market stays bullish. I don't think the market has exactly recognized the potential that this company has to still stay in the game. Again, the company has very good margins. It is mostly a software and data company. So they don't have all that overhead of building a store, building hardware. They don't build any hardware. The margins are very high for a company like this because it's mostly software. So when you take that, they have a lot of pricing power when it comes to what they're selling. Also, in terms of their entire ecosystem, no one else sells ad space on Reddit. Reddit does. They're a walled garden for their own platform. So they're not competing with anyone when it comes to this. So we'll see what happens with that one. You know, you saw that addition news when it comes to Meta monetizing WhatsApp. Like that was big news. And guess where Meta is sitting at? It's sitting above 700. Oh, sorry, it was maybe before the market closed, but it's almost at its all-time highs. Because this was the big thing when it comes to Meta. Not only are they a leader when it comes to developing an LLM model for pretty much open source for anyone to use it, but on top of that, they're also building hardware when it comes to its Ray-Ban Meta glasses or whatever the hell you call them. They have the Meta Oculus as well and all that stuff. They're in hardware. They basically own the family of apps, which apparently half of the world population uses every single day. And then on top of that, they also are monetizing their ad streams on all of the platforms and now including WhatsApp. So if they're able to do that, we're talking about continuing margin expansion. The market loves to see that. So, you know, this is another leader in my opinion. And I think that there will be a day and probably very soon, because like, look how bullish this chart is. Like, I don't understand like why anyone would short this stock. It's above all the moving averages. It's in a clear uptrend here. Okay. It's only down 46 basis points on a day where the Qs are down 1%. Like this is going to be back at 200 in a few months, right? Just without a doubt. Google's being back at 200 in a few months if the market stays bullish. All right. If there's nuclear war, you probably don't need to worry about your portfolio, right? Like if Iran drops a nuke on someone, like forget about it, guys. Don't even bother looking at portfolio anymore. Like you need to worry about other stuff besides that one. Lemonade. I already did lemonade, Tomas. Anyways, I didn't do a whole lot of it. I apologize. I'll probably do something more on the prepared side, throw it on the Substack or maybe release it on Twitter, whatever it is. But yeah, man, I need some water. This coffee just is not doing it. I could actually use some lemonade or some iced tea right now. Yeah. You're on mute.
Let's share something real quick. Just lighten up the mood real quick.
Precious thing in the world is the financial security and well-being of your family. You want to send your little ones to the best schools, and in the end, know that you've left them with peace of mind. Nowadays, we all know that cash rules everything around us. Cream, get the money, dollar bill, y'all. That's why it's time to enter the 36 chambers and step to the Wu-Tang Financial. At Wu-Tang Financial, we'll work with you to devise the best plan for you and your fam.
I mean, Smith Barney, bunch of bitches, old time farts. You gotta know how to jack this. You gotta play this game rough. You know what I mean? In, out, get, grab, bonk. You need to diversify your bonds, nigga. Military is blowing up. You about to go to war? Invest in some nuclear bombs. This ain't trading places, nigga. This is real life. Protect your goddamn neck. All right? Retain Financial. Pays for you and your kids.
All of our trusted consultants are here to meet your needs.
Unfortunately, the old dirty bastard couldn't make it today, but he sent his regards.
So call us. Because at the end of the day, Wu-Tang Clan ain't nothing to with.
Wu-Tang Clan ain't nothing. Wu-Tang Clan ain't nothing. Wu-Tang Clan.
I like how they beep out the F-bomb, but they don't beep out the N-bomb. Like I never understand that. Anyways, we're not sponsored by Wu-Tang Financial, but
We would like to be.
Yeah,
if Wu-Tang Financial wants to sponsor us, let us know.
So if anyone has any connections at Wu-Tang Financial, please let them know that we would love to be sponsored by them.
I would love to diversify my bonds and buy some nuclear bombs, bro.
Actually, I'm not diversifying any. I'm not buying any bonds right now, but whatever. That's
buy some TLT. Diversify your bonds.
Yeah. All right, guys. Well, you guys want anything? Want to know anything? Go ahead and check out the channel again. We're on YouTube where you can check out all our videos. We have tons of episodes on there. You know, we're in episode 37.
Are we?
And that's not including everything else.
You know what's sad? There's not a lot of opportunities in this market, bro. Like I'm scouring things and I can't find anything that's like, oh my God, like this is an obvious. I mean, United Health is the only thing that I'm.
But like would you go like
on, but that's because of a mean recovery. Not like super hard, but I think there's a mean recovery play, you know. But like I said, there's nothing that's like, oh my God, this is the most obvious play in the market kind of thing. Yeah,
you know. I don't think there's any of that right now because the problem is that as bullish as I am in GitLab, I mean, dude, we're like almost at all-time highs. So it's very hard to be a big size in something like that when if the market goes down, it's going to go down too, right? It's not like that's a tough part, you know. It's like we you know, the moves were made in the last couple of months. Now it's like just kind of just sitting back and just relaxing. I think one of the biggest things about making gains is just the patience, right? That's the biggest part about it. Like if you got to be patient in it, right? It's not like, yeah, okay, good. So you buy Google in the 130s, you bought Amazon in the 150s, you bought Meta in the 400s, you know, and you bought TLT when it was $83, you know, whatever. But now TLT's at 87, Google's at 180, Amazon's at 215, Meta's at all-time highs. Like, well, then now you just wait, right? You just chill. So, you know, that's about, I mean, you know, the day trading, whatever, swing trading, that stuff is fun, but like, you're never going to go full part on that one, you know, but buying a big size of some of these mega caps and they're cheap in a couple months ago, like that was when you did it, right? So
Robinhood especially, dude. When Robinhood dropped to the 30s, that would to me was an obvious buy. I just didn't jump it. I should have, but it is
right, man. You're still in the cruises because Carnival basically doubled since the lows in April. You know, what was another one that I mean, I'm just baffled how it was probably one of the most obvious things to buy as a dad. And I didn't hold on to it for more than a trade was this guy right here. Like this Roblox.
Oh, damn.
Wild chart. I traded this and sold it for a 15% gain.
What is with Roblox, dude? Like
okay, so let me give you this in a nutshell, right? So Roblox is, of course, the video game on the iPad and the phones and the internet that a lot of kids use, whatever, they're obsessed with it. And then there's communities behind each type of game that they have, right? So think of it as like a purely customizable Minecraft, but like basically a first person of Minecraft where you have much more engagement. And I think what they're going to profit on the most is the advertising in their game because they don't have ads pop up. They have embedded models and games that revolve around certain ads, right? So the other year I saw there was an advertisement or something.
That sounds like they're indoctrinating your kids, bro. What?
No, exactly, because it's a market that you can advertise to for basically free, essentially free, right? Like obviously got to pay for the ads, but like they don't need to do anything. They don't need to develop. Okay, so for example, there was this Roblox game called Chipotle something, right? They got people to go on there by offering a free Chipotle meal if you played it for like 15 minutes. But the whole thing was an entire ad campaign for Chipotle. And people at Roblox didn't even make that game. Chipotle hired people to design the game and market it for them. So all Roblox did was just take a cut from it, and they didn't do anything.
Interesting.
Right? So they
really
made so much money off of that. And like the obsession with this game is crazy. Especially there's a lot of big YouTube accounts. Like I'm talking about millions of followers and subscribers on YouTube that push people toward this game. And what do? They just record themselves playing this game. Like it is free advertising for Roblox. And at the end of the day, Roblox doesn't really create these games. And Roblox just designed the entire platform, and developers and engineers create these games in there, and they just host a server. And people join their server and play this game that they created. And it's like, the more it's like a YouTube video, the more likes it gets, the more it shows up in people's feeds. So it's like the same thing in their algorithm. And you can put whatever you want in these games. I mean, obviously there's an explicit, filtering and whatever it is. But at the same time, it's like, you have an ad campaign in there. It's just free advertisement campaign for Roblox. They drive people are being driven to the platform. They don't have to pay anything for it. So the margins are high, of course. And on top of that, it is based upon the smartphone penetration and device penetration around the entire world. So you're going to constantly get growth in the platform over and over and over again. And it caters to ages of all age groups. I'm not trying to pump this stock. I don't own this stock. I wish I did, because then I'd be pumping this stock all day, but I can't because I don't own it. So I have no benefit for doing that. So anyways, I mean, this stock is just up and to the right. But yeah, that's about it.
I wish you were here in Atlanta, man. I want to go to a driving range today and just shoot off a few rounds, just it'd be fun to
Dude, even if I did, I got like 2 rascals in my house, so like I can't
bring them along.
It is like a great day for it. Now my son, he would be down too. Actually, my son is starting to play some basketball, so I could start bringing him around and do some random stuff. So yeah, actually maybe I could, but maybe in a year or 2, I'll be like taking in the range with me and just shooting out there. So
yeah, no, I meant like a driving range, not a actual like. I mean, you could go to a gun range too, but driving.
No, I driving range. I need my golf.
Yeah, exactly.
Yeah. If I want to do that, I wouldn't go to Atlanta. I'd go to.
Oh yeah, you're in California. Wait, do they have ranges? Do you guys
do,
have
but
ranges
like
in
you have to go. Well, I mean, they have like a really expensive one in downtown LA, but like all of them in California was like far out east. So you can go to a couple of those, but I think it's expensive. It's super expensive. I mean, they have them here, but like it's just super expensive to use it. So of course they try to make it hard for people to do it. So
you want to hear something funny? My wife was off work.
You diversified
today.
your bonds?
No. She was off today. She was at home all day today. I've never wanted to not work from home so much in my life, bro.
Yeah, well, welcome to my life. My wife works at home right next to me. So
y'all both work from home? Oh, bro, I feel for you. I'm sorry. There's no personal time. There's no personal time.
Well, I get tons of personal time. I don't know what you're talking about, man.
Is she behind you? Blink twice if you need me to come rescue you.
Blinking.
Yeah. All right. Well, that was interesting. Thanks, guys, for being here. Thank
all
you
right,
for
guys.
Subscribing and liking and all that good stuff. All right. Have a good
All right.
one.
Talk to you guys later.
We need an outro. We we gotta figure this out.
We just ended. All right. It's done.
All right. Later.